Hi, I'm Erik Ogard, CIO of the Wealth Plan Group. Last week, we talked about the pivot party, the so-called pivot party, because the Fed is expected to cut rates come September. In fact, the market is producing a nearly 100% probability that the Fed will cut rates in September. Now, the big question is, what's on tap for next week's Fed meeting, July 30th and 31st? Some even expect the Fed may cut rates next week. We're not so certain about anything in July, and we think the market may be way too optimistic about a September cut. And the reason for that is purely, in a word, data. And we know, based on the things said by Jerome Powell, that the Fed is going to be data dependent. So we think the most basic thing to do here is to start looking at the data that matters to the Fed to try to get a sense for how likely is it that we get a rate cut in September. So in order to do this, you first need to identify what data is the Fed focused on. And it's pretty clear there's inflation data for sure, and there are really two series the Fed can look at: CPI, consumer prices, and PPI, producer prices. Now, producer prices are just a series of commodity prices. Those can affect consumer prices because their input costs, commodities, are the input costs into final consumer prices. So any pressure on the commodity side can, in a lagged way, impact future consumer prices. So we're going to look at the consumer price and producer price data to see if we can glean some insight into what the Fed needs to cut. Then we're going to turn our attention to jobs data. And we know that if people are employed and employment is growing, and that there are plenty of job openings and people are being hired into new jobs, the chance that inflation abates is lower than if the employment level is declining or at least not growing and the jobs market is shrinking, the available jobs market is shrinking. Those would be things that would suggest later on inflationary pressure may not be as strong as it is today. And so the jobs data becomes very important. And then lastly, looking at just broad economic data in the form of GDP or GDP forecasts. So we're going to look at those three things to see if we can get a sense, and also given some of the language used by Jerome Powell, to get a sense for what might be coming with rates. We're hoping to demystify this to determine if the pivot party is a little premature like it was in late 23, or if in fact this time we're going to see follow through from the Fed. It is going to be all about the data. So the first series, let's zero in on the consumer price index. We've had a stubborn CPI looking at year over year change, holding at above 3% until the most recent print, in which we pierced 3% just in the high twos. Now, the Fed has said 2% is their target, but they've also said that really waiting for 2% almost would guarantee an economic slowdown. And so they need to be anticipatory as to the direction of consumer price pressure. What we think is happening is probably we need to see a series of moves lower by September that indicate the trend is toward that 2% target. And we think in absolute sense that we probably need that CPI level coming in at about 2.5% year over year for the Fed to, cut rates. And so here we are looking at a time when we're at about 2.9, and we're going to have a couple more inflation prints before the September meeting. And the question is, are we going to get 0.2 decline each time, taking us to 2.5 or 2.6? If we're in that 2.5, 2.6 range by September, that might make the case strong for a cut. We don't think there's 100% probability or a 90% probability that we can get there. So on the pricing front, that's interesting. Now let's look at producer prices, because what we see in commodity prices is that they are now hooking back up. And the year-over-year growth is not very positive relative to where we were 3 years ago. There's not any commodity pricing spike going on, but we're seeing now a return to positive pricing change in producer prices, which certainly doesn't give relief to the current situation. So on producer prices, it's kind of like, well, if they're not sort of spiking into that 5 to 10% growth range, maybe we can handle this level here. Now, we've always been focused on what's causing these prices to spike as they did in the past 3 years. And we really think it's a function of money supply. And so we've created a chart here looking at the lead impact of M2 money growth, then the follow-on with producer prices, and then finally consumer prices. And what we see is a really compelling, strong relationship, albeit lagged, between M2 money supply and what happens in producer prices. And then later we get a more muted response from consumer prices. And there's certainly way more going on in the setting of consumer prices than, say, compared to commodities, which looks to be dominated by the money supply factor. Whether or not the other elements in the mix of that CPI number, whether it be the absolute level of interest rates, consumer confidence, the cost of housing, there are many things that can influence that final consumer price number. But to get it down, we see this chart relating money to producer prices and consumer prices. We are now seeing a hook back up in the M2 money supply to where it's turned positive after being negative for a few years. And we see right along with that commodity prices coming up. So it's a wait and see on those producer prices in addition to the CPI. And our view is we got to watch that money supply and we got to watch producer prices, because they might be an indicator of how hard it's going to be to get from that 2.9 level to the 2.5 level or the 2.6 level that we think the Fed needs to see. Okay, now let's turn to the jobs data. And we can see in the employment level that we've had a steady weakening in the year-over-year change in employment. It's still positive, but it's razor thin positive. So just on that metric alone, we can say or the employment level is becoming static. We're not seeing uplift in employment, which probably leads the Fed to say that's something that can influence our ability to cut. And that's signaling a green light for the cut right now. If we look to job openings, those have been shrinking for a long time year over year. And so the economy is peeling back jobs available for employees for many, many months in a row now, which also indicates that there's softness in the employment markets generally, and that would give credence to the claim. And that's probably the thing that's driving the market to expect a cut by September, is just that ongoing weakness in the employment picture. And then finally, let's turn our attention to GDP. Now we can look at the trailing GDP factors, and those are sort of notoriously difficult to rely upon because they change so much. They're revised after the fact for many months, and we get differing picture of what's happening with GDP based on that. But from everything we can see in the GDP data right now, the economy is just fine. Now, to address weaknesses in GDP, the Atlanta Fed came out with their measure of GDP now, which is a forecast for expected GDP growth. And even on that front, GDP looks fine. The strength of the overall economy, probably driven by federal expenditure, but federal budgetary expenditure, is the thing that you really can't say there's much help there for the case to cut rates. So we think it's very much an open question, and we think the probability is probably overstated in the market right now at 90 to 100%. We think it's less clear than that. If it's data dependent, we have to see progress in the next 2 months on actual CPI, and we'd probably even need to see some weakening in the economy in addition to the job growth weakness that we see. Overall, we think the pivot party, the exuberance related to markets' reaction to Powell's comments a week ago or 2 weeks ago are a little bit overdone. We think there's a chance next week when we hear from Powell that he begins to maybe walk back some of the things that caused the market to become overly optimistic about that September cut. It's still on the table for sure. We just don't think that high level of probability is appropriate. So That's where we are on the pivot party and the Fed rate cut and the expectations of the market and where we think the data is pointing us. Stay tuned. We'll be on top of this and we'll update it as information becomes available. Till next time, thank you.